When you think of a stock market crash or a catastrophic financial panic, your mind likely jumps to recent history. You think of the chaos of 1929, the global collapse of 2008, or the sudden freeze of 2020. Those moments were incredibly painful, but none of them were the first. Nearly 2,000 years before the New York Stock Exchange was built, the Roman Empire experienced a financial crisis so severe that it paralyzed global trade, collapsed real estate values, and forced aristocratic families to make unimaginable sacrifices just to stay solvent. And the underlying catalyst behind it, the exact same structural mechanism that causes modern banking systems to freeze today. Now, let's travel back to the year 33 AD. At this point in history, Rome was not just a military superpower, it was a highly sophisticated global commercial empire. Trade routes stretched across the known world, linking the markets of Britain all the way to the luxury producers of India. Goods, grain, and manufacturing flowed daily through Mediterranean ports. But the real engine of the Roman economy wasn't physical cargo, it was something completely invisible, a massive network of credit. Most history books paint a picture of the ancient world as a simple barter economy, where people only traded silver coins for physical goods. But that is missing the entire architecture of how large-scale business actually functioned. The Romans had a highly developed banking system run by professional financiers known as argentarii. These bankers operated out of stone offices surrounding the Roman Forum, and their daily business looked remarkably similar to a modern commercial bank. They took deposits from wealthy citizens, transferred funds across distant provinces via paper receipts, and, most importantly, they issued large-scale loans with interest. The Romans even had a specific word for this process, credere, which literally means to trust or believe. If you were a Roman aristocrat wanting to buy a massive olive plantation in Spain, or a merchant wanting to finance a fleet of grain ships from Egypt, you didn't carry chests of heavy silver coins across the ocean. You walked into a banking office in the Forum, secured a loan based on your reputation and your land assets, and used that credit to execute the trade. For decades, this system worked flawlessly. The bankers kept a portion of their physical coins in their vaults and loaned out the rest to the public to maximize their interest returns. This is a concept modern economists call fractional reserve banking. It expands the amount of money circulating in an economy, allowing businesses to grow far faster than they ever could if they relied purely on physical cash. But this entire architecture relies on a single, fragile assumption. Everyone has to believe that the system is stable. The moment that collective trust wavers, the entire mechanism turns upside down. In the year 33 AD, the Roman economy was at peak capacity. Money was cheap, loans were easy to get, and the elite were heavily leveraged, meaning they had borrowed immense sums of money to buy up real estate across Italy and the provinces. To the average citizen walking through the Forum, the system looked completely bulletproof. But beneath the surface, a structural regulatory shock was quietly brewing in the halls of the Roman Senate, and it was about to pull the rug out from under the entire empire. So what was that shock? It wasn't an invading army or a failed harvest. It was a forgotten law, a piece of Roman legislation that had been sitting on the books for nearly a century. And when someone decided to enforce it, the entire credit market collapsed. To understand the catalyst, we have to look at a forgotten piece of legislation that had been gathering dust for nearly a century. Back during the days of the Roman Republic, Julius Caesar had passed a strict law aimed at keeping capital concentrated inside Italy. The law mandated that any citizen engaged in large-scale lending had to invest at least 2/3 of their wealth directly into Italian real estate. For decades, this law was completely ignored. Rome was expanding, wealth was flowing, and the Roman Senate simply looked the other way, while bankers and politicians channeled their capital into highly profitable ventures across distant provinces like Gaul, Spain, and Egypt. It was a massive shadow credit market, operating completely outside the bounds of the law. But in the year 33 AD, a group of aggressive state prosecutors decided to enforce the forgotten statute. They brought formal charges against several high-ranking senators for violating the investment quotas. The political elite panicked. They realized that if they were convicted, they faced massive financial penalties and the confiscation of their property. They immediately petitioned the reigning emperor, Tiberius, for a grace period to get their accounts into legal compliance. Tiberius granted them exactly 18 months to adjust their portfolios. This is the exact moment the dominoes began to tip. To comply with the law, every wealthy politician and aristocrat in Rome had to do two things immediately: sell off their foreign investments and call in the outstanding loans they had issued to others, demanding immediate repayment in physical silver coins. They needed cash, and they needed it now, so they could buy Italian land. But the elite didn't just lend money to each other. They were the primary funding source for the Argentari, the commercial banks. When the wealthy elite demanded their capital back from the banks, the bankers faced an overnight liquidity crisis. Imagine if every major depositor walked into your bank tomorrow morning and demanded their entire savings account balance in cash. The bank would instantly collapse because that cash isn't sitting in a vault. It is out in the world, tied up in mortgages, business loans, and infrastructure projects. This is a classic bank run. The Roman bankers had no choice. To survive the sudden drain on their vaults, they turned around and ruthlessly called in their loans to the public. They contacted shopkeepers, shipping merchants, and farm owners across the empire, delivering a brutal ultimatum: repay the full balance of your debt immediately, or face asset liquidation. Suddenly, the entire Roman economy ran out of breath. The abundant, cheap credit that had fueled decades of unprecedented growth vanished in a matter of weeks. The financial system was about to find out exactly what happens when everyone tries to exit a crowded theater through a single narrow door. That door, it slammed shut. Here's exactly what happened next. When the banks called in their loans, the public faced an impossible reality. Landowners, international shipping merchants, and provincial governors did not have millions of physical sesterces lying around in cash. Their wealth was locked up in physical assets: olive groves, brick factories, wine vineyards, and cargo ships. To raise the cash demanded by the banks, everyone was forced to do the exact same thing at the exact same time: list their properties for sale. Basic economics tells you exactly what happens next. When the market is suddenly flooded with thousands of real estate listings, and absolutely no one has the credit to buy them, the balance of supply and demand shatters. The real estate market didn't just dip, it completely collapsed. Beautiful, high-yielding Italian estates that were worth millions of sesterces just a month prior were suddenly selling for a fraction of their original value. And this is where the dominoes struck the core of the Roman aristocracy. The ancient historian Tacitus documented the panic with clinical precision. He recorded that whole families were ruined. He described a brutal chain reaction where the initial failure of a few large debtors instantly dragged down their creditors, wiping out fortunes overnight. As asset values plummeted below the value of the outstanding loans, the banks began ruthlessly repossessing property. If a merchant couldn't pay his silver debt, the collectors didn't just take his shop. They seized his furniture, his tools, his livestock, and his warehouse inventory. But the liquidation went even deeper, exposing the darkest, coldest mechanical reality of the ancient world. When a family ran out of land and material assets to sell, the law still demanded repayment. To satisfy their creditors and avoid being thrown into a debtor's prison, ordinary citizens and broken elites were forced to sell their dependencies, servants, and in the most extreme cases, their own children directly into the slave markets just to raise a few coins. This wasn't a poetic metaphor written to shock readers centuries later. This was the raw, legal reality of a society where human beings were classified as transferable property and calculated as line items on a liquidation balance sheet. The panic quickly spread outward from the capital. Because Rome was the financial hub of the Western world, the freeze in the Forum caused a ripple effect across the provinces. Trade ships in the ports of Alexandria and Carthage stayed docked, because merchants couldn't secure the short-term credit needed to pay for crews or buy insurance. The construction of aqueducts, roads, and private villas ground to a sudden halt. By the summer of 33 AD, the greatest empire on earth was completely paralyzed. The financial architecture had broken down so thoroughly that the survival of the state itself was called into question. Every eye turned toward a lonely villa on the island of Capri, where a reclusive, calculating emperor held the absolute power to either let the system shatter or rewrite the rules of money forever. Emperor Tiberius, watching from that lonely villa on Capri, was forced to confront a concept that modern finance ministers know all too well: the paradox of systemic risk. If Tiberius did nothing, the Argentari would completely liquidate, wiping out the savings of the patrician class, freezing global trade networks, and potentially triggering mass civil unrest across the provinces. But if he chose to step in and save them, he would be using public state funds to bail out the exact elite, politicians and speculative lenders who had created the crisis by over-leveraging themselves in the first place. The emperor chose survival over sentiment. He engineered the world's first recorded systemic bailout. Tiberius issued an imperial decree that completely bypassed the frozen private credit markets. He ordered the imperial treasury to withdraw 100 million sesterces, an astronomical fortune representing a massive portion of the empire's liquid reserves, and deposit it directly into the banking offices surrounding the Roman Forum. But this wasn't a free handout. It was a highly structured liquidity injection. The Treasury distributed this capital to a select group of highly regulated, trustworthy bankers under very strict conditions. First, the money had to be issued as interest-free loans directly to the struggling landowners and citizens who were facing immediate foreclosure. Second, the loans had to be secured by real estate assets worth double the loan amount. And third, the borrowers were granted a fixed window of 3 years to stabilize their finances and repay the state, completely interest-free. The mechanism worked with clinical efficiency. The moment public silver flooded back into the forum, the psychological panic dissolved. Landowners who were on the brink of ruin used the interest-free state capital to pay off their aggressive private debts. The banks, suddenly replenished with physical cash, stopped their predatory asset liquidations. The real estate market bottomed out and began to stabilize, and trade ships in the distant provinces began to clear their ports once more. By injecting massive liquidity at the absolute core of the network, Tiberius had successfully restarted the empire's financial heart. But while this emergency intervention saved the Roman economy in the short term, it subtly altered the structural relationship between government and capital forever. Before the year 33 AD, the state viewed the financial system purely as a passive source of tax revenue. But by acting as a lender of last resort, the imperial throne established a dangerous precedent. Tiberius unknowingly introduced a structural flaw into the economy that modern financial analysts call moral hazard. By shielding the financial elite from the ultimate consequences of their speculative behavior, the state implicitly demonstrated that if a crisis grew large enough, the public treasury would step in to absorb the losses. The elite learned that risk could be privatized for profit, while failure could be socialized for survival. The Panic of 33 AD was eventually resolved, and the immediate memory of the crisis faded from the history books. But the underlying architecture remained unchanged. The exact same psychological triggers, the same regulatory pressures, and the same structural bailouts would continue to repeat across human civilization, changing only in name, technology, and interest rates. So here is the question you've probably been asking for the last few minutes. Why should you care about a credit freeze from the year 33 AD? Because the architecture has not changed. Only the builders have. When you look at the modern financial system, whether it's the global collapse of 2008, the massive liquidity injections during the 2020 pandemic, or the abrupt bank rescues of 2023, you're watching the exact same script play out. The technology has evolved from hand-carved clay ledgers to digital fiber optic cables, but human psychology around risk and trust remains completely identical. Every single time a modern central bank like the Federal Reserve lowers interest rates, steps in as a lender of last resort, or pumps billions of dollars into a failing banking network, they are using the exact defensive playbook engineered by Emperor Tiberius in the year 33 AD. The core lesson of history is that money is not just physical metal, paper banknotes, or digital numbers blinking on a smartphone screen. Money is a system of collective trust. When the ancient Romans stopped trusting that the Argentari could return their deposits, the greatest commercial network in the Western world froze solid in a matter of weeks. When modern depositors lose that exact same trust, the exact same freeze occurs. The system stops breathing because credit is the oxygen of economic growth. So, the next time you hear a financial analyst or a news anchor declare that a modern market crisis is completely unprecedented, or that this time is different, you can look past the noise. You now understand that the structural rules governing wealth, panic, and government intervention are thousands of years old. Human nature doesn't change. Only the interest rates do. But this realization opens up a much larger, more dangerous question. If the Roman Empire fully understood the mechanics of credit, fractional reserves, and emergency bailouts, why did their economy ultimately face total collapse centuries later? Why couldn't they just keep printing money, injecting liquidity, and rescuing their financial institutions indefinitely whenever a crisis hit? Because they eventually hit a hard mathematical wall, a limit that every civilization in human history eventually encounters. And when a system hits that specific limit, it breaks in a way that no amount of government bailing out can ever fix. But before we dismiss class today, here is your homework. Take a close look at any banknote inside your wallet or the digital terms of your bank account. You will see a statement declaring that the currency is legal tender for all debts, public and private. That statement is a formalized state-backed promise of trust. The ancient Roman merchants didn't have that guaranteed safety net. They built their entire global network on nothing more than their word, their reputation, and their ledgers. When that word broke, the emperor had to step in to save the world. Today, the central banks step in. Same architecture, different century. If you want to move past the superficial headlines and truly understand the hidden, structural rules that run our global economy, through the raw, real-world history of panics, power, and human behavior, make sure to hit that subscribe button right now. Let's keep reading the receipts that history tried to bury. Class dismissed. Go look at your phone keyboard or the cash in your wallet. Those systems are thousands of years old, and they are still running your life. I'll see you in the records.